We're live.
Good morning, everyone. I want to call the emergency board to order. The materials to follow along for this meeting may be found online at aoa.vermont.gov/revenue. We'll take up agenda item number 1 first, the private activity bond allocations for calendar year 2025. I'd like to invite our treasurer to present. Good morning.
Morning. Well, good morning. Thanks for having us. I know right out of the gate, you'll have the riveting topic of private activity bonds and the allocation for the upcoming year. But for the members of the emergency board that might be new, these bonds are private activity bonds done by private entities, not by the state of Vermont. So the 4 to think about are VSAC, VITA, the bond bank, and DHFA are the ones that primarily use this allocation. Even though it's not the state issuing the bonds, they still benefit from the tax exempt status. So they make them more attractive to the marketplace, makes it less expensive for us to finance things that are important to invest in as a state, like student loans, economic development, housing, and the like. So you'll see from our presentation that so far for 2025, the allocation would be for $60 million of private activity bond cap to VITA and $30 million to the Vermont Bond Bank with a contingency of about $300 million. That is what it gets closely watched throughout the year, and then we make a final allocation toward the end of the year. Anything that is unused will get split between the DHFA and the bond bank. Like I said, right? VSAC, sorry. So like we did last year, as you have in your materials. So I believe there are a couple of motions that we are requesting relative to this initial recommendation from our office.
Are there any questions? I'll read the motion if someone doesn't want to do it. Do you have a question? Or would you like to move it?
I will move. I move to approve Vermont's private activity bond allocation of $388,780,000 for calendar year 2025 is recommended in the letter from Treasurer Piecyk to the emergency board dated January 21st, 2025.
Motion's been made. Is there a second?
Second.
Is there any further discussion? All those in favor, signify by saying aye.
Aye.
Those opposed? The ayes have it. Approved the motion. That'll be a second motion.
If I make that, this motion is made pursuant to its authority under 32 VSA 992 that the emergency board grants the authority to the Vermont Municipal Bond Bank to assign any portion of its 2025 private activity bond ceiling to one or more government units as defined in 24 VSA 4551. Right?
All right. Second is made. Any further discussion?
The municipal bond bank is the same as the Vermont Bond Bank. They're not separate.
Yeah, that's right.
It's the same name. Just
Yeah, I think it may now be the Vermont Municipal Bond Bank. So you want to add another name?
Any further discussion? All those in favor, signify by saying aye.
Aye.
All those opposed? The ayes have it, and you've approved the second motion. Thank you very much.
Thank you very much, Governor. Thanks, Doug.
We'll now take up agenda item number 2, the official state Medicaid report. I'd like to invite Roland from the Joint Fiscal Office and Rich from AHS to present the report.
Good morning.
Good morning.
For the record, Nolan Langwell, the Joint Fiscal Office.
And Richard Donahue, CFO for AHS. Good morning.
We're going to be pretty brief this morning. As you know, we come before you twice a year. In July, week I came and I briefed you on the Medicaid year-end report, which required no action. However, in January, we present you with the Vermont Medicaid program estimated caseload and estimated per member per month expenditures for the fiscal years 25 and 26. Just like Tom and Jeff have been working together for a really long time, this particular consensus group has been doing this for a long time too, at least 10 years. And so this provides a lot of consistency and trust. As you know, we do our best to make estimates based on the best information we have available at the time. The past several years, post-COVID years, have been a bit wonky and challenging to predict. In short, there appears to be a new normal that frankly is still shaking itself out. We continue to see decreases in enrollment in the major medical eligibility groups, we refer to them as MEGs. However, utilization is still up. As such, spending is not anticipated to decrease despite the drops in enrollments. We aren't quite sure specifically what is driving this utilization trends, but we'll continue to work together to monitor the situation.
And this fiscal year represents the first year post-COVID where the redeterminations cadence is more back to normal as pre-COVID.
So you have a motion, I think, in your packet.
Any questions?
Just to clarify, the redeterminations are complete?
They are mostly complete, that is correct. And so now we're back to the typical annual redeterminations process under Medicaid.
And so do you expect these levels to be sort of where we are somewhat stably pending economic changes? You said wonky, and so I'm sorry to dive into whatever.
Yeah, no, it's fine. I think the answer is there's a new normal, and it's sort of, we haven't really quite figured out what that new normal looks like.
Regarding the utilization,
Yeah.
the caseloads seem to be stabilized.
And it's a case, okay. Thank you.
Any further questions? Is there a motion?
I'm sorry.
Okay, go ahead.
And the caseload stabilization, does that look similar to pre-COVID in terms of the makeup of the groups, if not the numbers?
Really.
Okay.
No, there's a variance there in the mix among the Medicaid eligibility groups, but in terms of where we are post-COVID, there seems to be a stability across those eligibility groups. Now it's a question of degree of utilization.
Good question.
Is there a motion?
I'll make the motion to accept the Vermont Medicaid program's estimated caseloads and estimated per member per month expenditures for FY 2025 and FY 2026 as explained in item 2 in the meeting materials.
Motion's been made. Is there a second? All kinds of seconds. Any further discussion? All those in favor, signify by saying aye.
Aye.
All those opposed? The ayes have it. You've approved the motion. Thank you very much. Now we'll move on to the main event, the official state revenue estimate. I'd like to invite Jeff and Tom to present the consensus revenue report. Good morning.
Good morning.
Here we are again.
Yeah, good to be here. So,
Good day for snowman.
very good day for snowmaking, that's right, yeah. So entering 2025, the economy is doing really well, exceptionally well. Aggregate measures of economic activity have rarely been better. We're seeing productivity growth extremely strong. Real GDP is tracking in the fourth quarter to be above 3%. And then the new Commerce Secretary has this 3-3-3 target thing, and that's one of them, is to have GDP up in that range. That's not easy to do, but right now that's where it's tracking. And it looks like 2024 may come in pretty close, a little bit under 3, but for real GDP growth to be that strong is exceptional. All this is happening with a lot of job growth, low unemployment rate despite high interest rates, and the inflation metrics are looking very good. The PCE deflator, which is what the Fed uses to gauge monetary policy, is 2.4%, and it's not 2%, which is what they want, but it was enough to allow 100 basis points in cuts starting in September. And there had been plans for more cuts. That's kind of on hold. And the reason it's on hold is there's uncertainty around some of the policies that are coming down the road. But the impact of the good economy on revenues has been a positive, of course. It's not drastically different from what we forecast before, but on page 14 of the handout that I have and Jeff has comparable tables in his, you can see that just the 30,000 foot changes. We're only recommending adjustments in fiscal 2025 of 1.8%. And oh, I'm sorry, do you not have a copy of the other one?
No, we don't.
Yeah, okay.
Jeff got it.
Yeah, good. In 26, 1.4% and 1%, 0.5%. These are trivial adjustments. There's a lot happening under the covers, and we can get into some of that if you're interested, but that's kind of the broad perspective.
It's reflecting our first half, which is hard to argue with where revenues were over the first half, particularly if you look at the general fund, and particularly in personal income tax, corporate income tax, with an assist from the state, a little bit from insurance, a little bit from property transfer tax, although I blew the formula for 2025. So a little bit of that strength is the fact that I didn't get the formula right in the cash flow targets. We're doing really well in the transportation fund and one component of the ed fund in motor vehicle purchase and use. That being said, while we were up almost across the board in the transportation fund, except for transportation to diesel tax, we were down almost across the board in the education fund. And, we're still trying to feather in the changes from the 24 session. We have had to do some mathematical gymnastics because the surcharge in the meals and rooms only goes to the ed fund. And, kind of not the way we forecast things. We kind of forecast the whole bunch of meals and rooms together and then usually apportion it out. So we had to do some mathematical gymnastics on that one. And so we're still trying to figure out what's going on with the tax changes, particularly the one that we don't have any data for, which is the one that changed the sales tax on software, because that's all commingled. So we don't know whether or not we have a situation where we have some demographics going on in the sales and use tax, because we all know that older people tend to spend more on services, which aren't generally taxed, versus younger people who spend on goods, which are generally taxed. So we're trying to figure out all those kinds of things going forward. But in the G fund, we're talking about 3 years, over 25, 26, and 27 of over 144 million bucks up. In the T fund, over that same 3-year period, we're talking about 8.3 million up, but we're talking about $20.9 million down in the ed fund for 25, 26, and 27. And then we have the 2 years that we provide out, which are the fiscal planning numbers, which aren't as rigorous as the first 3 years. So if we look at the 5-year total, it's 156.8, and then G fund up, it's 9.9 million up in T fund, and that includes the downdraft in TIB that we forecast. And then we have a modest downward adjustment, it's 56.1 million over 5 years in the ed fund. And we are going into a situation with the new administration where we're looking at another modification of supply side economics when you consider tax cuts, which is probably going to be pretty easy to do. Then the new proposals, and I don't know how they're going to pan out, but if you restrict illegal immigration, but you also restrict legal immigration, you can have ramifications on labor force growth, particularly the last 2 years.
For the record, he's talking about the other.
Yeah.
Yes.
No,
Clarify.
I appreciate
the
clarifying.
federal administration, excuse me. And then the third part of their tenet is $2 trillion worth of budget cuts. And you would have known that I wasn't talking about Vermont, we talked about $2 trillion in budget cuts, but that's going to be the most difficult to deliver. So we might have a situation where we're looking out 2 or 3 years from now, where we've got a firmer situation with inflation than we don't like, which could compel some additional changes in federal monetary policy, which may not be all that helpful.
We pretty much took a wait and see approach to what would actually happen, because there's been so much talk, and it's just hard to know what talk is going to translate into what policies. But it does look like there's a whole lot more advanced planning done with this second Trump administration. So there were people that, sharpened their legal pencils and figured some strategy, whether they'll hold up in court or not and things like that. They've got a whole bunch of things they're going to be trying to do. So it's impossible to go down all the rabbit holes of stuff. But as they are clarified, then we'll look at them. But in general, I think most people expect that quite a few of them would be inflationary, particularly the tariffs. And bond markets felt the same way. So that's why long-term interest rates were pushed up somewhat. And the Fed, importantly, I think feels like they could be inflationary. And that's why they're putting the interest rate cuts on hold. And then we'll see what the numbers say. If the economy's running hot with, if labor markets are still pretty tight and inflation doesn't come down anymore, then I think they'll just stay put. Some people even think they might raise rates, but if there were a deterioration in, it's not right. No, I don't. That's not anywhere close to consensus. But holding them is not too hard to do. It's just then they'll start to be political.
We have two in our forecast. We have two short-term cuts for this calendar year.
After June.
Feel free to be interactive here, so we don't wait till the end for the questions.
To clarify, when you were projecting out sales tax and the reduction in ed fund projections, did you take into account the potential tariffs?
No.
Okay.
So that's not explicitly in there.
Okay.
No, a little bit higher
Is it
inflation.
implicitly in there?
Well, a little bit higher inflation, but there's no, what would you do? What
I have no
policies,
idea.
which countries?
Right.
So
Who's going to retaliate?
Yeah, but I do think there's been, you'll see a few things that strengthen motor vehicle purchase and use. Some people suggest that there might be some advanced buying going on because people know that, there's been chatter about, how much could it raise prices? If it's Mexico and Canada, you could see $7,000 or $8,000 per vehicle, additional. So it takes a while for that to work through the supply chains. Some of these companies, manufacturing companies, have been purchasing parts and inputs to the vehicles and stockpiling them in anticipation of possible changes. So it's just too early to say, and we'll be watching all this closely, and in July, we'll hopefully have more clarity. I don't know.
What happens if we end up with Canada, Greenland, and Panama Canal?
Right. I haven't seen stats on Greenland. I don't know what they're.
Well, I heard they got minerals.
Yeah, I know, but that's future stuff anyway.
I think there is I would think that they are stockpiling in some respects, especially like aluminum from Canada, trying to get that imported if possible.
Yeah.
Yeah,
The supply chain is a lot more complicated and less resilient than a tariff on Canadian goods or Mexican goods would probably allow, given what everybody tried to do the last time they renegotiated the U.S., Mexico, and Canadian trade agreement, which they're now looking to renegotiate again. Because what happens in that situation is that someone's gain in the United States becomes a more expensive part that comes from Mexico or Canada or something like that, and the supply chains can't spin around that quickly. So there could be, that's part of the reason I think that many economists, when they load up their modeling artillery on these things, argue that they tend to put a floor on the prices or increase prices.
There are a lot of carve-outs too in the tariffs. Last time there were, and one of the reasons there are all these CEOs down at Mar-a-Lago and giving $1 million to the inaugural event is that they hope they can get the carve-outs that Tim Cook got at Apple the last time around. And that's the kind of thing that, they're wrinkles, and you could easily see stuff like that happening too. So it could be sector by sector.
And I think the other thing that's good, some of the federal tax changes that have been talked about, we're talking about on the campaign trail, we're kind of insulated from because of the way we connect into the federal situation now.
At the beginning, you said that the economy was exceptional.
Yeah.
I assume you meant that. Then it seemed like you're focusing on national economy. Would you use the same adjective for the Vermont economy?
Yeah, I think the Vermont economy also has been great. I mean, we run these One metric, and this is kind of unusual, payroll job growth in Vermont in 7 of the last 8 months has grown at a faster rate year over year than the national. That isn't, the last time that happened was 14 years ago. So that's good. And we we had these charts on unemployment by state. I think it's
The second
this
lowest
year,
unemployment.
page 4, we're the second lowest unemployment. And we sort of take this for granted because almost always Vermont's up there. But this is it's a really good thing. When you think of what's the purpose of an economy, if somebody wants a job, they can get a job here. And that is that's nothing to sneeze at. So the thing is, these are aggregate metrics, and economists took a lot of flack during the election year for saying how great these aggregate metrics were. And then there are people, whether they're being told they feel this way or not, or whether they actually feel this way, have complaints about what's happened. And obviously inflation was a big one. But even aside from that, a lot of people just say, well, the economy stinks. Well, it does for a lot of people. We have, there's a chart on page 11 that shows the stock market growth, and in the last year it was exceptional. It was 26.7%. And yet the preceding page has a table that shows how much of those corporate equities and mutual funds are owned by the bottom 50% of the population, right? That's 66 million households own exactly 1% of that. So it doesn't matter to them if the stock market goes up. You're not going to be any better off. And when you look at the ownership of corporate equities, so that's page 12, half of it is the top 1, and of that half of that is the top 1/10 of 1%. So they're pretty concentrated, economic vantage points and experiences, and that differs. And you can look through a range of different things, asset classes and such, and there are a bunch of charts in here that take a different perspective on it. And from that vantage point, you could be doing considerably worse than an aggregate number might show.
We like the stock market to do well, though, like other asset classes, because that means good income for us.
So a lot of the things that benefited, the revenue categories that benefited, were things that were affected by asset prices. So corporate, personal income, and estate all have potential tax liabilities driven from transactions involving assets.
Unanticipated tax liabilities which come in revenues because they don't plan them away.
Well, that's the estate one, but in corporate and personal income, sometimes they're planned.
Well, but sometimes when you get more capital gains from the stock market and you haven't estimated across the year for that, it comes in April. So we like good performances by the stock market.
Right, sometimes
we like them to be unanticipated.
Yeah, well, anyway.
This goes on all day.
The point is, assets across all classes have been rising. And, that's a win for some people. And in the case of housing, it's a loss for some. So you own a house, great, my equity's going up and I have more value. But if you're trying to buy a house for the first time, or you're trying to upgrade, it's terrible. And so you can have an aggregate number that's telling one story and then a whole lot of other stories underneath that are winners and losers.
Has to help our pensions as well, right?
Yes, it does.
Stock market.
Yeah.
The booming stock market must have a positive effect on that.
Absolutely. Yeah.
Back,
go down too.
back to the housing, and I want to link that back into the tariffs, because if we do end up with tariffs, lumber and other things from Canada is going to increase the cost of building.
Right,
right. So that's
and the
something
labor
to be
side
worried
of it,
about.
not so much for Vermont, but for a lot of the country. I was in New Mexico recently, and you go to a construction site there, everybody's speaking Spanish. So that's the
roofing, tilers, framers are all.
Yeah, so that in Texas and through big parts of the United States, a large portion of construction markets, healthcare services, again, these are low end kind of things, hospitality, agricultural labor, all those benefit greatly from immigration and
Immigrant workers are, in some of those categories, over a third of the workers.
Well, we have that in dairy here, farming.
right,
Right, true, agricultural production, absolutely.
Right,
right. But being so far away, we're not as quite as, you know, like if you're less apt to have a Spanish-speaking plumber than somebody,
Right.
you know, yeah. Anyway, yeah. But it's been a great boon to the economy because you increase population and in a productive way, and there's jobs for everybody. So then they're producing and generating wealth, and you know that's sort of what the economy's
Or GDP, GDP compared to other states and so forth. I mean, it's tiny, but is it?
I haven't looked. I mean, it's commensurate with the size of the state has been growing, but you know they revise that data so frequently that if I were to tell you what the number is now, that you know you can look back in those tables that we have. We go year by year,
989.
and you'll see, yeah, that like okay, back in 2008, this is what they said, you know, about the change in GDP. Now it's like sometimes a sign even changes, you know. But so you know, it's a useful kind of yardstick. We could do some runs though if you want and just show comparative growth and things like that.
And the seasonal factors in the labor market data are just because of COVID and because of what happened and because the labor department emphasizes the last 5 years, they're whacked. I mean, and you know, you see it in the non-ag payroll job counts. On one hand, we've just barely gotten back and recovered the jobs, 68,000 jobs that we lost during the pandemic-induced downturn. But if you look at the number of people that are employed who have a job, the employed people, which is a survey of households versus the non-ag jobs, which are a survey of business establishments and jobs that are there, we're one of 2 states that are leading the region in terms of the number of jobs that we've added since the onset of the pandemic. So the number of employed people. So there's a lot of, and some of that's a function of hybrid work environments and things like that, which is confusing all the data. So if you throw that on top of the seasonal factors, we not only have to know the data, but we have to know how the data are wrong now to the forecast.
so when you are talking about jobs, are you talking about full-time jobs or part-time jobs?
Well, the non-ag farm jobs are both full and part-time jobs.
Okay, so.
And you know, I mean, our travel and tourism industry, you know, sometimes gets a bad rap for having part-time jobs. There are some people that have multiple part-time jobs. There are some people that are here for the ski season in the winter and then go to South America during the summer for the ski season. And so you know, our travel and tourism industry sometimes gets a little bit of a bad rap.
But that's where you get down below the top line number. You say, okay, job growth looks really good. Well, what about the quality of the jobs?
Exactly.
What about the pay of the jobs? What about
What is it?
hours and can I work remotely and on and on and on. So there are things like that that are important to understand too. There's not always good statistics on all the stuff below the top line numbers.
But the good news is that if you look at the JOLTS data, which is a jobs labor turnover survey, there's 15,000 jobs in Vermont available. So, I mean, sometimes there's a little friction between where those jobs are located and where people live, but that's still, you know, a pretty good number out there. And there's still 2 jobs that are available for every unemployed Vermonter.
So on page 18, there's a chart of states.
Yeah, no,
I'm sorry.
I'm good.
No, go ahead.
No, you say what
I had a question. The governor's done a good job in the past of highlighting the concern about demographics. You have a bullet point on demographics here on page 6, but you said for the first time since 1957, we've had a decrease, but if you look at this chart, we've had a decrease. So I don't know what you're saying. What was the first time in 57? Not that we've had a decrease, just that the census has changed their numbers?
No. Well, several things you just said are true.
Okay.
The chart you're looking at that you're saying comparing to, those are births. That's age 0,
okay. This is just
age
the
0
births.
population,
Okay.
yeah. So not total population. And so in 2024, after a series of revisions that census has made, they completely restated the data, the intercensal years between 2010 2019, which they regularly do.
Which we
But
were
then they
waiting for a
also
long time.
restated the data from 20 to 23 and added 24. So we maintain these databases of single age population for the state because we use it in lots of the forecasts that we do. And, you know, the reason being is it's something that's pretty easy to forecast because if you ask me how many 3-year-olds are going to be in Vermont next year, pretty much how many 2-year-olds are there now? And then that's most of them. You get a little bit of loss out through domestic migration in and out and international migration in. But for the most part, you know, that's how it sits. So we use this data, we look at it, so I was just showing the birth stuff as an example in there. But what I was referring to is total population. So our forecast of 2024 population actually was only 136 people off. So that was a forecast from a year ago.
Yeah.
And, you know, that's 0.02%. That's on 648,000 people. That's good. But what Census did was they revised 2023 up, and so 2024 is a decline, not by much, it's 215 person decline, but it's the first decline since 1957. So that's, you know.
They had other declines in their preliminary numbers,
Yeah.
but they revised them away.
That's right.
So
There are
now
other years.
what we're doing is we're talking about the most current data set that
That's
we
right.
have.
That's right.
So it isn't that they haven't said that we declined.
So there's a small decline as far as how you see that as you're projecting the economy going forward. What's the
It's not
level of
earth shaking. It's very close to what we thought it would be.
And I expect that to be
mean,
revised away at some point.
well, but also if I'm off by 0.02% in a forecast, I'm happy with that. I'm not going to be
Even if we
changing
got the wrong.
my models. The thing that I think is most notable demographically, or one of them, is that there was a lot of population inflow around just after the pandemic and around the pandemic. And the state didn't lose a lot of that. You know, there's more normal flows back and forth, but it's not like we kept gaining and gaining because remote work is, you know, more and more accepted. Hybrid work is more and more accepted, but it seems like the trend is kind of turning
The
against
tide is kind
full-time
of turning.
remote, although there are plenty of jobs that are solely remote, and it seems like there's pretty strong worker preference anyway for that. So if workers have relative power to, you know, in a labor market, you might see more of that. But we're not getting as much long-term population growth from that as
But it was a really good boost.
yeah, but
It was a really good boost.
yeah, the birth numbers are just such, and again, there can be revisions. Just before that, just on the total population, there were years between 2010 and 2019, the census was estimating population that they thought there were declines, small declines.
Right.
So that's why
It changed it all.
the 1957 number might have been invoked back then, but then those got
They
revised
revised.
away.
So if you're still here in 2033 or 2034, you can
You
see
might-
that they might revise this way
They might
by the
be-
time you
It's
get.
close enough to the middle, that's not what counts, but the declining births is something that affects school age populations and enrollments, and reminds me of the first forecast we did for enrollments in 1996, and if you look at that chart on births, which is what, page
Oh, you had
8,
3 charts in there that showed
Yeah.
change.
right?
You had 3 charts in there that showed change with that.
Yeah, right, so if you see,
Fertility
back
rates and-
in 1996, there had been this, you know, steady decline starting back in about 1990 of births. So when we forecast enrollments, we were going out, starting to forecast declining enrollments. And nobody believed it because enrollments had always gone up. So they said, that's ridiculous. You know, that enrollment go up, that wouldn't be a prudent thing to assume. But it's kind of baked in the numbers. There's not a whole lot that can change unless you got a lot of domestic migration that changed it. And it hasn't, you know, that's sort of trending down, and it's based on fertility rates, which is the other chart, and Vermont's lowest country on that. That's the latest
Quite a
data,
bit.
2022. Yeah, so the only way to move the population needle is through migration, and the biggest flexible migratory group or international migration, but that's harder to absorb, as we've seen in some communities, like the Ohio community that had all the dog and the cat eating stuff that was wrong. But it's just sometimes it can be hard to digest a very large group, but certainly we could have more of it. And I think in a state like this, but this comes at a time when immigration is being throttled down. So I don't know, that could be.
The other thing that happened on this front, which made it a little difficult for us, was we normally get, when you get past the decennial census point, it normally only takes them 3 years at the most to go back and re-revise the mid-year estimates from the previous decade. It took them 4 years and some change.
Yeah, it was
This time.
pandemic.
Some of it was pandemic related, obviously,
No,
but
they were up to their
so we
necks.
were trying to do long-term forecasts on a data set that
We had our own
we
estimate.
had our own estimates because we didn't believe what they were reporting for the mid-year estimates.
And we didn't have a decline in the period, because based on other stuff we were looking at, that didn't look reasonable. So we were running with our own numbers, and they turned out to be closer to
Better,
what we
yeah, better.
ultimately revised to. The other thing
They
about
don't care about
calculation
Vermont very well.
is this chart on page 9 that shows Vermonters over 65. And, I mean, there are things about an aging population that are problematic from a state perspective, certainly from a federal perspective, because transfer payments from the federal government to elderly people are very substantial. But at a state level, that's not the same sort of thing. So if you look at the tax data on average income tax paid per return for those over 65 and under 65, you see that those over 65 consistently pay more in income tax per return. So that income comes from lots of things, saved wealth, from transfer payments from the federal government, from a whole lot of things, capital gains, various stuff like that. But the notion that somehow old people are supported by young workers from a fiscal perspective is not necessarily true. And it's on the expenditure side, from a state level, our biggest single expense is K through 12 education. Those are not people that have a lot of children utilizing K through 12 educational services. So it's you don't have the same expenditure burden. You have, at least in this state, pretty good income and wealth. And it's, so there are issues with
Medical
it.
utilization would go.
Medical utilization will go up. A lot of that's paid by the federal government. So anyway, just another wrinkle to the whole
Paper
thing.
boomer
Sometimes,
heavens, that's what they call us.
well,
We're helping pay for public
they're not
education.
bad things for that, because they're making payments, steadily. Anyway,
Can I change the subject a little bit? And I don't want to spend a lot of time on $1 million in a multi-billion-dollar conversation, but you devoted a whole page to tobacco. So I'm wondering if there's anything you want to say about it. 19
In Tom's report.
in Tom's report.
yeah, because I did the first cut of the cigarette and tobacco stuff. Whenever we find an anomaly in the data, something we don't expect, we try to dig into it, and these sorts of things show up sometimes. Sometimes there are problems with the way data are being collected and various things like that. But what we saw was a decline in e-cig expected revenues, right? And that had been something that had grown very quickly. I was expected to keep growing. And it didn't. For the past 6 quarters, it's been declining. And so the question is, what's happening? And there's a new nicotine delivery system, relatively new, of these nicotine pouches that is just exploding in use. And the way we tax that, because it is taxed, but in other tobacco products, and it's not clear exactly how the wholesalers are remitting on this. So we need to do more work on understanding it. But the equivalent weights that are used for other tobacco products are based on, if you roll your own cigarettes, let's take that amount of tobacco, figure out what would be an equivalent to how we're taxing cigarettes so we don't lose money on that kind of thing. weight of these nicotine pouches is such that the equivalent number of cigarettes is, like 1 ounce of those things is 70 pouches. All right. And that's equivalent to, 21 packs of cigarettes. And that's a very different kind of thing. So I think we need to look at this as a developing issue. It may go beyond nicotine at some point too. It's a chemical delivery system. And the problem with, addictive chemical delivery systems, which is essentially what that is, aside from the wasted resources people that get addicted are stuck with, it's targeted, it seems heavily targeted to young people. Because if you get somebody addicted young, you've got them for a long period of time. And that's clearly in the tobacco playbook. The largest manufacturer of these nicotine pouches is Philip Morris. It's a product called Zyn, has 75% of the market. So it's being marketed with all the expertise that a company like Philip Morris can do. It's also 6 times more profitable than their cigarette lines. So it's really being emphasized. They're spending almost $1 billion in new manufacturing facilities to meet demand. So we should be prepared, and I know there's been policy discussion on it, but when it's hitting the tax revenues, we're going to lose money if we don't do it. It's not huge dollars, but by 2029, it's $6 million. So, it's just an issue. And then it's a public health issue too. Not that there is there's not scientific data saying, oh, for sure, we know this is the negative aspects to nicotine pouches. They're new, so who knows? But you can use it in a classroom in a way you can't a cigarette or even vaping, where you get a little bit of visual from that. And so it could be widespread with young people. And
If there's a way to deliver nicotine to the marketplace and make money on it, they'll figure it out.
yeah, and they'll change as fast as.
Yep, as soon as we catch up with them, they take the next step somewhere else.
Yeah, but I do think the concern is well, why would you stop with nicotine if you could do that with some other chemical that could be addictive that somebody likes and work it the same way? I don't know, but just raising it is something that came up when we did it. It was more complicated than some of the other discussion because it's sort of new.
Thank you.
We didn't talk about childcare tax stuff, but there's been some confusion just in the way it's on the tracking sheets. Do you want to go into that?
Well, basically what we did, since it's new, and it's not like adding a point to the Meals and Rooms tax, it's a significant new tax. We always had some concerns that there would be compliance issues. It just normal things, not that anybody's trying to hide. It's just that when you implement a new tax like this, there can be lack of information out there and things like that. And so when we were thinking about early on, when we did the forecast, how we were going to track it, we track it currently in a theoretical sense. Okay. We expect, since it's been paid through personal income withholding, we've expected that a certain percentage of personal income withholding would represent the 1% on payroll. The other part of it, which is the self-employment tax, we're not even expecting to come in until people settle up their annual returns this spring for the first time. So, so far during the first 6 months, and now we're into the 7th month of the year, we've been carrying a theoretical hypothetical deduction for personal income withholding. The first quarter actuals came in, and they've come in below. And the Commissioner of Finance and Management has been fond of telling me that's the first time you've overestimated anything in my history with you. So we still are carrying that, even though we only have actual filings from the July to September 30, which were due at the end of October. There still are people that the compliance people are speaking with about whether they owe it. And now we're getting to the end of January, which means the October to December quarter filings are due, which for those of you that aren't even good at math know that we'll be sitting here at this time next year and we won't even have a full year of it, data. So we still think it's prudent to carry ahead at theoretical level until we get actual data in that says that it didn't produce that much. We may have some truing up to do on June 30th for where we are to date, but that probably will still be reflective of some compliance issues as we catch up with people that owed it and haven't paid it. And believe me, the hybrid work arrangements and everything have made it all more difficult to do this. And our tax system is largely voluntary compliance. So this is going to put that to the test a little bit on that. But the reason that I'm saying there's a difference between what's being filed for and what the theoretical number is means that we get to June 30th and the actual numbers don't true up to the hypothetical. That means the G fund inures more money, which means that you would have more resources to deal with the special fund and other fund transfers that you have to do with that. But, we probably won't have that reconciled by the next emergency board meeting. It'll probably be sometime next fall for you to deal with that.
What I would say is, given that a payroll tax is, is certainly subject to fluctuations with economic changes, and that this is a new tax type and I appreciate that you all are holding your projections steady, and that childcare caseloads are going to change too, right? That we're beginning a conversation about a reserve, and that might be prudent to do before July 1st.
Right. Well, I still think forecast is a good one that we did because we used the federal data. So things that we don't know. I mean, we put in the seasonality of the personal income withholding tax as a whole, but without knowing, there are some people that work for a Vermont company that live out of state that aren't subject to it. And then while, we have some compliance growing pains on the payroll side, they're going to be nothing compared to the self-employeds and the proprietors that are going to be paying the other part of the tax, which is why it's only a million or two at the other end. So, so we're going to be flying a little bit without the benefit of a lot of actual data for probably about a year and a half or even 2 years. But I think the way that we originally have been tracking it is a prudent one because it says this is what it should be generating based on the best data that we have. If it doesn't generate that much, that doesn't put you in a budget crunch for those line items in the budget side. So that's, we think was the right thing to do statistically and forecasting wise, but it also happens to be probably the best way to do it on the budgeting side for all of you that have to deal with those types of things. I'm so glad I only deal with revenues and I don't deal with expenditures.
Me too.
How about interest income?
Yeah, that's a good one. There's a chart on page 18.
It's on 12 on mine.
But it's got to, we've committed those funds, so somewhere, when does it level off? When does it bottom out?
Well, we think, and this is in consultation with the treasurer's office and the treasurer, that would flatline at still a little over $1 billion. So not like it disappears because there's some of it's transactional with it, but there was a steeper drop off in the first half of fiscal 25 than we had originally thought. We've modeled different scenarios of interest rates and cash balances and all the rest. And then you have an effective interest rate, which is essentially the mix of all the different things that are getting invested in and the timing of that. But we, that chart on page 18 shows you the sort of, every single revenue series that we analyze, we seasonally adjust. And it doesn't, rarely does it get presented to anybody. When you listen to federal numbers, they always say seasonally adjusted annual rate, here's da, 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 da. We don't do that, but that's how we analyze stuff. And you can see the seasonality in this from the raw data, which is the black line, and seasonally adjusted is blue, and the red is a trend cycle, which is a little bit of a smoothing. But you see how quickly it dropped off. And that's going to be money that's spent in the Vermont economy in the next year or so. So, on the ground, that should be a real stimulus. There's only about $1 billion a year in new construction starts across all kinds, residential, non-residential, non-building in the state. And that could be as much as $300 or $400 million that's been drawn down. So Doug Farnham knows more about the drawdown details than probably anybody, but that's happening. And it may, though, be something that the federal government decides they want to try to rescind if there's unspent money. So that could be an issue going forward.
Working very hard, trying to commit all that so that does not.
And that shows in the declining balance over the first half of fiscal year 25.
Yeah, so if it goes down faster, though, it means we get less interest income. Just that's our.
To follow up on the governor's question, is that cash balance going to rebase higher than you have in say
That's what I was getting at.
Yes.
like-
Yes,
Yes.
okay. Do you have a sense of where?
About $1 billion.
Well,
Okay.
actually, where we have it is about 1.2 million.
1.2, yeah, but that's
And actually,
close enough.
it's closer to 1.3. It's 1.267.
Okay. Thank you.
Yeah, that's the assumption in the forecast.
And I have a bet with the governor on that.
What do you think?
What do you get?
I'd say it's, consistently over 20 years, it was about $400 or $500 million. I'd say, double that probably.
Yeah, I'm sort of more in that camp, but so far, and I don't know if Mike's still in the room, but the treasurer's office has been saying, and they have pretty good understanding of how the flows come in and out. That's what they're carrying, so we sort of went with that. But just based on the historical numbers, I'd be lower.
Well, we don't
The
have,
reason they gave it to us was to stimulate the economy and get things going and spend it.
not that we have the fifth largest source of general funds. Yeah, that source of general funds, yeah.
But some of it is slower hiring, that happened, especially post-pandemic, things like, so there were savings and things like that. That's the stuff that maybe will stay if those are efficiencies, or might not, but.
And the other part, obviously, is the interest rate side, what the effective interest rate is. And the treasurer's office has been very good at negotiating. So if interest rates are stickier and track higher because of firmer inflation, you'll get some effective interest rate relief on a greater decline in the balance. So there's two things that.
I'm sure 10 years ago, if you thought about or considered maybe $90 million of interest income, we would have said, no, that's not possible.
Yeah, right. 5 years ago, that was.
Yeah, that's right.
Yeah. So anyway, we're getting better and better models to.
Yeah, that's
forecast it
incredible.
too, so it's getting, yeah.
I think that is quite
And we eventually hope to get this down to a monthly model, once we get enough experience.
Yeah, that's hard because the way things mature, the economy.
Well, we'll see.
Yep.
Oh, there's one other thing. Because the state tax is tracking so well, we're probably going to hit the higher education fund transfer amount. State tax, excuse me, which is 28,835 or something. I wrote that somewhere. But our expectation is that we're going to hit that at some point, not by a lot. And I went back and looked, and the last time a state tax went over 27 million was back in 2014. So this is going to be a first time thing.
It was a totally different tax structure then too.
Yeah, well, then, it's been changed since then, obviously, but this is the first time that the July 125% of the July forecast is going to result in actual revenues coming in higher over the course of the fiscal year than the 125% cap of the July forecast, consensus forecast for state.
So when we say it goes to higher ed, the trust fund.
Yeah.
And on the tables, it just means that the source state number 29 and change, and then the available general fund table, which is the next
It's the
table,
cap.
is the capped amount.
And I,
So for the mathematicians that want to go back and use the source to available, they're going to see that it's different, and it never is in the state tax, except when it is.
and I know we're running out of time here, but on the estate tax increase, how much of that do you expect to be sustained year over year, and how much of it there was sort of a temporary jump that people weren't planning for, and that's why the estate tax
I think the higher asset prices are gonna keep this elevated, you know, and it's hard to know sometimes exactly what the value of assets are and, you know, so I think though there's gonna be an elevated level in general. There's just a long, you know, there's a longer lag between that run up and seeing it in the revenue data, but it's affecting, you know, corporate and personal.
I joke with Tom that we keep talking about these one-time non-repeatable events, that we probably have to have a forecast for one-time non-repeatable events.
For my entire legislative
Yeah,
service.
yeah.
That's-
Yeah, but it
But it's true, they're one-time non-repeatable events.
well, but also, you know, the magnitude of them is such that, you know, that it makes the data very lumpy, right? So there's more volatility in personal income and corporate, and that can go up and down. We are getting a lot of the up right now. So, you know, just
From
be
2008
aware of that.
to like 2015 or 16, we were getting a lot of that, except in very unusual
When you
circumstances.
see home prices doing what they're doing, the charts and you see the stock market doing what it's doing. You know, I've been around the block with a lot of these sectors, they go down too. So there's a lot of room, there's a lot of downside room on these things, and that does the opposite with asset prices.
Any further questions? Yeah, have a motion, please.
I'd like to make a motion to accept the state revenue estimates pursuant to 32 VSA 305A for fiscal year 2025, 2026, and 2027, as explained in item 3 in the meeting materials.
Motion's been made. Is there a second? Any further discussion? All those in favor, signify by saying aye.
Aye.
All those opposed? The ayes have it, and you've accepted the motion. Thank you very much.
Thanks.
Now, take up agenda item number 4, the impact of authorized TIF districts on the education fund. I'd like to invite Dave Feldman, the tax department, and Ted Barnett from the Joint Fiscal Office to present. Don't take any offense to the press leaving the room. Not you.
Ted Barnett, Joint Fiscal Office. We are here through VSA, 32 VSA 305B. The Department of Taxes and Joint Fiscal Office is required to produce a consensus estimate of the maximum fiscal impact of TIF districts on the education fund. We look at trajectories in property tax rates, property value increases, and individual TIF district development patterns to produce this estimate. And in fiscal year 26, that estimate is $6.5 million. And I'll let Jake talk a little bit about some of the background.
Thanks. Yeah, Jake Feldman, Tax Department. Excuse me. So we are in consensus on the $6.5 million for FY26. A little bit of context. It's a maximum impact. So with TIF, it's not clear to what extent the development would have happened anyway, even if there was no TIF. So in developing this number, tax and JFO took kind of a worst case position, which is that the development would have happened anyway. And if you look at it that way, the cost is a maximum $6.5 million loss to the ed fund.
And if it wouldn't have happened?
Pardon?
And if it wouldn't have happened?
Oh, great question. So with each TIF increment, 75% usually is withheld by the town and 25% is remitted to the ed fund. So if you take the position that TIF is working perfectly and all of the new development is happening because of TIF, then it's actually that 25% that you're looking at. And in that case, the ed fund is actually up by a couple $1 million because of TIF. The truth is probably somewhere in the middle.
Thank you, Governor. Can you just give me some historic content of the 6.5? Is that pretty steady what it's been in the past? Is that an increase, decrease?
It's pretty steady. We've actually had some graduation lately in TIF. Burlington's waterfront is coming off the books for FY26, except for a few parcels. So that is actually lowering the number. And last year, Winooski graduated. So that lowered the number. So it's been actually above 7 million for the past few years. And we're thinking 6.5 for the coming fiscal year.
Any further questions? Entertain the motion.
I'll move to accept the consensus estimate of the impact on the education fund in fiscal year 2026 of authorized TIF districts as explained in item 4 in the meeting material.
Is there a second? Any further discussion? All those in favor, signify by saying aye.
Aye.
All those opposed? The ayes have it. We've approved the motion. Thank you very much. We have our last agenda item. Actually, agenda item number 5, the education fund outlook. No motion is required, but Julie Richter is here to answer any questions. Are there any questions?
I feel like given all the attention on the education fund this year, it would be prudent to have her just talk us through it.
Thanks very much for joining us.
Absolutely. I'm Julia Richter with the Joint Fiscal Office. Included in your packet is an education fund outlook. This reflects 2 significant changes from the December 1st letter. You'll recall that the December 1st letter is based in statute. It's consensus with the administration and the Joint Fiscal Office based on statutory assumptions for modeling, including using all unreserved unallocated to buy down for uniform bill change. That projected a 5.9% average bill increase across all 3 classes. The Ed Fund outlook that you have included in your packet reflects 2 significant changes from the December 1st letter, which we always update for the emergency board. This reflects changes to the FY25 appropriations from the Governor's Recommended Budget Adjustment Act and the updated revenue forecast that you all just adopted. Shall I walk through what those changes mean, or do you have specific questions?
That'd be helpful.
Sure. So as you note, the January consensus forecast showed a decrease in the forecasted Ed Fund revenues, non-property revenues for FY25 and FY26. That's a decrease from the July forecast for FY25 of about 6.6 million and FY26 a decrease of 5.1 million. The appropriation adjustments for fiscal year 25 also decreased the uses from the education fund by about 13.7 million. So when combining the 2 together, the downgrade in the revenue forecast with the change in appropriations, there's 2 million additional on the bottom line of the education fund. So there's a 2.8 million unreserved unallocated that you see there in the bottom row 40. And this is in addition to the Ed Fund Stabilization Reserve being fully funded.
And this assumes no one-time general fund payment either, which we did this year. So even making up for that.
Yes, that's correct. So the general fund, the one-time general fund transfer that was included in the big bill last year, you see on line 8, that was 25 million in FY25, but assuming no general fund transfer in FY26.
Okay. The gap is.
Yeah.
Am I correct in saying that you're projecting the yield would go up because of this, if we make the changes in the BAA and the revenue forecast we just had, if the budgets all stayed what we thought they were in December, then the yield would go up?
Yes, that would be a policy choice based off how you wanted to use the additional 2 million. So for comparison purposes, the yields and non-property tax rate we see reflected here are the same yields and non-property tax rate as the December 1st letter. You are correct that if the 2 million were to be applied to uniformly lower property tax bills, then we would see a slight increase in the yield and a slight decrease in the non-property tax rate. I emphasize slight because that would really only be about 2 million.
That's my best.
Any further questions? Thank you, Julia.
Yeah, thank you.
Is there any further business? Hearing none, entertain a motion to adjourn. All those in favor?
Aye.